Dear friends, welcome to the monthly outlook on markets. Corporates recently concluded their Q1 FY25 performance. The quarter continued with slow revenue growth for India Incorporate. BSE 500 companies saw its revenue growing by 8%, similar to the growth seen in last two quarters, while the profit grew 11% ex of oil and gas companies. However, this quarter was impacted due to weaker economic activities led by lower government spending given the just concluded union election and the heat wave affecting out-of-home consumption. Strong operating profit growth was predominantly seen in consumer durables, defense, pharma, industrials. However, relative weakness was seen in cyclical areas like cement, metals, oil marketing companies, and also railways. Let us now look at sectoral trends in greater details. Starting with manufacturing, infrastructure, or investment-driven businesses. Utility businesses reported strong performance driven by increased power demand and higher volumes sold through e-auctions. Infrastructure companies actually faced execution-related challenges due to unavailability of labor and lack of regulatory clearance due to union election. Companies in this area saw mixed execution, partly due to elections. Order backlog continued its growth trajectory, albeit with some temporary delays in order inflows. Companies are optimistic about the medium-term business outlook with strong inquiry levels across industries and increased demand. Growth areas over medium term include data centers, railways, metros, electronic manufacturing, power, water and water treatment, and many more. Let us now move on to consumer-related areas. Post the election outcome, government has stepped up efforts to drive improvement in multiple areas of skill development, employment. La Nina conditions also should have positive impact on the rainfall and thereby rural economy. Also, the hiring trend by IT companies, which was subdued for more than 6 quarters now, has started to see some initial signs of turns. FMCG companies' offtake was impacted due to extreme heat waves affecting out-of-home mobility. Most companies witnessed a marginal sequential improvement in rural markets, which could see further support from normal monsoon. Within consumer discretionary, paints and QSRs reported numbers below expectations due to soft demand. Alcobev companies surprised positively on profitability. Consumer electrical companies reported healthy numbers, led by strong demand in summer-led products like air conditioners. Other products like washers and refrigerators are also seeing improving trends. Fashion retailers continue to see weaker demand trends due to weak demand and fewer number of wedding days during the quarter. This can, however, possibly change as we move forward. Overall, after a weak demand scenario for a while, expectation is of broad-based improvement in consumer demand trends. Let us now move on to IT companies. IT companies continue to report slow growth. Macro environment for IT companies is characterized by economic pressures, including interest rates, which are affecting customer behavior and discretionary spending. North America in particular is seeing a relative improvement in client spending, especially in financial services segment. Let us now move on to pharma companies. Pharma companies expectedly reported decent performance. Domestic companies reported growth in line with their long period averages. Growth has been aided by chronic, acute, and in-licensing opportunities. US generic businesses continue to see relatively lower price erosions, paving way for superior earnings growth going forward. Another important trend seen in the quarterly results has been the converging performance of corporates across market caps. As we can see from the table, operating profit X of oil and gas companies across market caps has been in the range of 10 to 16%, with small cap companies in particular at the lower range of this band. We believe market performance from here on will be driven by more bottom-up stock ideation. Also, we believe divergence in performance across market caps and ownerships should also reduce. Markets today are backed by expectation of strong corporate performance. India in corporate have a higher ability to deliver mid-teens earnings versus the past. Markets today are at a juncture where globally economies are not in recession, but there is no strong recovery either. Markets will continue to fight this yin-yang. We believe a particular style of investing may not work, but a high focus on stock picking, premised on secular long-term businesses with execution prowess, and not necessarily focus on mean reversion or cycles. Thank you.